Hey everyone, John Henry here, slingshotfutures.com, and welcome to the Market Mindset, where we take a look at the psychology of the moves today so we can better understand tomorrow. And today we're taking a look at the Australian dollar Forex pair on just a really nice grind lower. Now, overall, this movement really didn't start out looking this bearish, right? We zoom back a little ways and we can see, okay, you know, for the most part, we were just kind of finding our way back and forth on both sides. Lots of range-bound movement, sellers selling the highs, buyers attempting to fade the lows. But when they failed to go back up, right, notice this big area down here. We have the prior low. And when they came back down to that area, buyers try fading in, and they get the move, but notice that it can't make it back to the highs. And that's a really big clue, because now we're going off of subsequent lower highs. We have the lower high here, and then we have a lower high here, and now this would be another lower high that turned down. So that disproves a lot of that range sentiment. Now, the overall range traders, in that case, when it starts failing back to the lows, they're going to be looking to potentially get out with as minimal amount of damage as they can, and sellers are going to begin swarming in, knowing that the downside is very likely now for potential continued breakout. Now, the continued breakout, as we always do with Forex, we start at 7 o'clock and then work our way forward. They had a really nice attempted bullish pop right there, as well as a twin reversal, both trying to get the buyers back in, right? They try to find a little bit of demand down here, they find a little bit of demand, and then it just completely gives up the ghost and tanks through the bottom. Now, this aggression to the downside, you definitely expect to see a second leg to it. It might only be to a quick little new low, it might be for some heavy continuation, but either way, we're anticipating that the lows are going to be tested again, or at least attempted to. So selling into this rally higher makes a lot of sense, and you had two really good opportunities to do so. Either on that first bullish attempted spike higher, that's what we call a one-for-one spike, or the move back down after the buyers had failed above the highs that allowed the sellers to swarm in and tank the move lower. As we started breaking down again, we saw another big breakout move. And generally, like we saw yesterday and like we talked about yesterday, when you split a low like that or any level of support or resistance by about, you know, the halfway point of the candle, that's showing you more of a breakout sentiment. But the follow through is the important part. The follow-through is really, really bad in terms of the bears, but the buyers, nobody's going to want to buy that, not after this kind of move. It's a little bit iffy, right? So sellers may not want to be selling this far down. They may wait for a slight correction, but the buyers have a really bad case, which is good for the sellers regardless. So when we get a quick little bounce back up into the fast-moving average, sellers dump it right back off. Once again, just continuing this bearish pressure. They can't even close above the fast-moving average, showing that the sellers are just pure domination on this downside. And with this heavy of a candle, that allows a quick follow-up sell to drive the market back lower. And if you didn't take that one, you had one more final one before the big drop, which was this guy right here. The buyers try to push higher once again. All of their efforts seem to be pretty futile because it's proved nothing but sellers' inventory once again and formed a huge bearish rejection back down. And in this case, given the amount of times that this has occurred, this is more likely going to be a bearish breakout, right? We have a bearish wedge forming right there, and we're breaking out of the bottom edge in an already very bearish environment. Now, not very frequently is this trade going to work. This is a very low probability type of trade because most of the time a wedge, a range, they're all treated about the same. A breakout that's going along with an already existing trend is showing signs of weakness. That's not what you want to see, right? But again, the follow-through is the important part. They get the massively bearish candle, and then they follow it up with another very bearish candle closing on its lows. Sellers are swarming all over this thing, and when that type of situation happens, the low probability event creates a very large reaction, and the market fell apart down to the lows. So just a phenomenal day of trading on the Australian dollar. Everything else was pretty quiet, but man, the Aussie definitely paid off quite well. So that's going to do it for this one. Hopefully you learned something. Hopefully you found it interesting. Have a good weekend, and we will see you all on Monday.